Good afternoon. Thank you for joining us today. Hope everyone is doing well. This is Bill Karsten, and I am joined today by Tom Loftus, who will help lead our discussion. For those of you who may be joining us for the first time, this is the third installment in a planned 8-part investment webinar series. After hosting sessions in early February and early March, we had a little bit of a pause there and postponed this third session in light of the extenuating circumstances our clients were facing due to the COVID-19 pandemic. If you'd like to access or revisit one or both of our first two webinars, they can be found on our website at planpilot.com. But rest assured, this session in and of itself should provide useful information, even if you have not to date participated in either of those first two webinars. We know you all have a lot on your plates right now, and we appreciate you taking 30 minutes today to join us. With that said, it is our goal to make this well worth your time. Should you have questions, please submit them in the chat box, and we will address them as time permits during this presentation or afterward if time runs out. So getting started, how does PlanPilot go about identifying best-in-class investment managers for our clients' plans? Looking back to our second webinar in this series, we noted that institutional investments are typically focused on long-term results with an emphasis on downside protection. However, we also quickly caution against leaning too heavily on a fund's past performance in your fund selection process. But past performance can provide meaningful insights when reviewed in combination with other analysis and qualitative or non-numbers-based factors. In summary, while quantitative or numbers-based metrics are important and can help us quickly narrow the field of investment manager candidates, we must place equal emphasis on qualitative attributes. So it's stated here, understanding an investment strategy, team dynamic, and other qualitative attributes provides necessary context for reviewing historical results. So in addition to the questions that are listed here for you to see, I'll offer up a couple more. Is the fund strategy consistent with and within the boundaries of the fund category we are seeking to fill? In other words, we need to remove outliers or managers who either regularly or from time to time stray outside the boundaries of their fund category. Another question is, has there been consistency in the fund's management and management team, and are we comfortable that a reliable succession strategy is in place? Most importantly, we need to provide our clients with reasonable assurance that the investment manager or management team can be expected to deliver long-term positive results relative to their fund category through long market cycles. So looking forward or looking further, pairing quantitative and qualitative analysis can provide better assurance about a fund's future ability to match its past results. So what are some key questions we must answer in completing this analysis? Does our analysis indicate that the team has demonstrated skill in adding value, or does it appear they have simply been lucky? Skipping ahead, are periods of underperformance justified and explainable relative to the fund's long-term strategy? With regard to setting proper expectations, what market conditions cater best to the fund's investment strategy, and when will it likely be challenged? In short, we want to set proper expectations for our clients in various market conditions and market cycles. Now I will turn the discussion over to Tom Loftus, who will take us through a case study that highlights our fund review and recommendation process.
Thanks, Bill, and thanks for that context. So as Bill mentioned, these next few slides in the presentation are going to cover an actual case study example of a fund that we had selected for many of our clients by applying all of the same concepts that Bill has already covered. in addition to it just being an interesting story to share, we felt that a case study example here is really necessary to exemplify some of these concepts that Bill has already spoken to, particularly when it comes to the whole notion or idea of applying qualitative analysis to interpret or better understand the numbers that you're looking at when you review historical performance. It's just not that well spoken to when everything is conceptual without the real life experience of an example. So that said, I just want to use this slide to set the stage. So this is an actively managed large cap equity fund search that we did in 2013. And as Bill teed up front, and if you know who Plan Pilot is and what we do, the framework or objective for this investment option is something that is retirement focused or otherwise fits the profile of an institutional investment, something that's long-term focused, something that's disciplined, repeatable with an emphasis on risk. So the starting points and what I've captured here on the slide are just a few high-level screens that we had applied to help us better identify what a good candidate fund in this category would be. And you can see above average long-term returns, low standard deviation or risk, lower downside capture, meaning a product that when the market is doing poorly is losing less or is doing a better job of hedging away losses, and an above average Sharpe ratio, good risk adjusted performance. So very high level screening to help us identify what we think could be a good candidate investment option. So this next slide jumps ahead a little bit. It highlights exactly when the fund decision was made back in 2013, and you can see along this rolling chart when we selected the investment option. And before going any further, I just want to take a minute to explain exactly what's going on with the chart that you're seeing here, because it's one that we've referenced in past webinar installments. We're going to be referencing a similar chart later here this morning, and you're almost certain to see it pop up again in future investment webinars. So what we are looking at is a chart that plots the fund's rolling 5-year excess return, meaning anything above that horizontal x-axis at the 0 point indicates periods where the fund was outperforming its benchmark. Anything below that are periods when it's underperforming its benchmark. And again, this is a 5-year rolling chart. So at any point along that orange line, you are looking at the 5 years of trailing performance leading up to that point. And again, I'll reiterate, this is rolling excess return. That's why if you look at your y-axis, you're seeing numbers that start at 0 and go up to 6 and as far down as -8. These are not the absolute returns of the investment over time. This is all relative to what the benchmark returned over that rolling 5-year period. The last point that I'll make relates to those 4 different shades of gray that you see lying behind the chart. That's a representation of the entire large cap equity category, the peer group. The rest of the peer group populates each of those 4 quartiles of the category. And at any point in time where you see the fund plotting amidst those 4 shades of gray are how it was performing at that time relative to the peer group. So for example, at the time of investment where you see the fund almost off the charts good, that's indicating that the fund was really performing ahead of the entirety of its peer group. So with that context in mind, what does this chart tell us then? And from the looks of it, and without any further explanation, you might take away from this chart that we bought into the investment at exactly the wrong time. We bought high right before the fund went low, and since that point, it's still done a good job of generating some competitive performance, but it's certainly not, multiple percentage points ahead of the best of its peers. So, putting that in the parking lot, I think anyone on the line is smart enough to denote that we're not going to include a bad story or case study as an example here to exemplify good, prudent fund selection and fund oversight. So there's a lot more to this. And what I've glossed over up to this point were all of the more involved steps of the fund analysis that Bill laid out earlier. And the last point that I'll make before moving forward and digging deeper into those attributes of the analysis is the fact that, this level of deep analysis not only got us to the point where we were comfortable selecting the investment for our clients at the time that we did that, but because we had and have that strong fundamental understanding of it, as we've seen performance trend in and out of favor, we have the knowledge and peace of mind that the fund is still doing what it's intended to do. And accordingly, we haven't made any premature decisions to, say, for example, at a point in time where it dipped into the bottom half of its category on a rolling 5-year basis. We did not make the decision to terminate the investment option because that, in our mind, would be exactly the example I gave earlier of making the wrong decision at the absolute worst time. So jumping ahead and incorporating that qualitative analysis into this case study application, I think this will help clarify a lot. And I want to take a minute to explain, I could easily spend the rest of our time together explaining the qualitative attributes of this fund. But I do want to note that one of our future webinars is going to be focused exclusively on the qualitative analysis of funds and how to digest that type of information, how to make informed analytical decisions around it. So I'm going to keep my comments a little bit more reserved. And for right now, what I really want to focus in on specifically is how we digested and interpreted the qualitative attributes of this fund as they directly apply to a better understanding of the numbers, the historical numbers and the forward-looking numbers that we expect. Because again, the title of this webinar is Identifying Best-in-Class Investment Managers by Dissecting the Numbers. And while it seems a bit counterintuitive, we argue that the only way to properly dissect those numbers is by having that good, strong, fundamental acknowledgement of the qualitative attributes of a fund. So keep this snapshot on the previous slide in mind as I talk through things here on the following slide. We identified this fund as a good performer. We did a little bit more digging, and we found the fund's objective. So this is a fund that by mandate is intended to outperform its benchmark by capturing more of the market's upside than its downside. And it also has an explicitly denoted secondary objective of identifying quality companies that may perform better than peers in down markets. So just that additional piece of information lends our analysis team some idea of how to digest historical performance. This is a fund that should have been performing well when markets were challenged, and when that's not the case in historical periods where the markets have been more robust, we would certainly want and expect the fund to be keeping pace, but by design and by objective, that is not where this fund is touting its value add. So putting that into the parking lot, we dug a little bit deeper into the other qualitative attributes of this fund and the sponsoring fund company. So we know that this investment is run by a boutique investment manager that is very focused. They only have 5 total investment options that they offer, and they're a relatively concentrated team of portfolio managers and analysts. Of note to us, we could see that all of the firm's personnel have very long tenures with the firm. Digging even deeper than that, we can see that most, literally a vast majority of their employees started as interns with the company and have since worked their way up the ranks within the company. It's a completely privately held company that's owned by its portfolio managers and analysts. So, these are a lot of small tidbits of information, but what this is telling us from an analytical perspective is that when we're looking at historical performance, we can trust that it's the same teams and philosophies that are focused on ensuring that any historical success that these funds have realized is something that can be reasonably repeated on a go-forward basis. And at the same time, we now have some confidence that the folks that are running these products are incentivized to do well. They're owners of this company. It's a concentrated team where if you're not doing your job, the finger's quickly pointed at you. So we know that there's some true manpower behind the long-term success of this investment option. At the same time, when we dug a little bit deeper into the qualitative attributes of the portfolio itself, we saw that it was a very concentrated portfolio of holdings with a high active share. And what that means is that the fund is very distinct from its benchmark. While it's still true to that large cap equity category, it's not afraid to establish positions that are very differentiated from its benchmark. So, how do you take that information and apply it to the historical results? Well, that tells us that this is a fund that is almost certainly going to endure periods of performance where its results look very different than the benchmark. And with that emphasis on downside risk, what I would say is our shaped expectation is that this is a fund that should look very different for the better when markets are challenged. And at the same time, it will look different for worse when markets are robust. But that's a key point to mention too. When this fund is not doing well on a relative basis, tends to be in periods of time where the markets themselves are doing very well. So that is not to say that the fund is objectively performing poorly. It's capturing much of the market's upside and generating very healthy returns for investors. But when it's out of favor with its strategy, it is predisposed to lag in certain periods. So with that in mind, the next slide that I'm covering here, slide 8, digs down into that historical performance a little bit more deeply. And it was more of a checkpoint for us to verify, is this fund actually delivering on what it is intended to do? Because we ran the high-level screens, we knew that it was an objectively strong performing fund longer term, but to Bill's earlier point, that could be luck. We need to see that the fund is performing well and it's performing in line with the objective and precedent that's being set by the team that's running it. And so what the snapshot on the slide shows is a calendar year breakdown for the last 20 years of how this fund has performed versus its benchmark and versus its average peer. And I think with maybe just one exception in 2015, this fund has always delivered exceptionally well on its mandate of losing less when markets are challenged while still generating returns that keep pace with the peer group in more robust markets. That is almost perfectly pervasive when we look at the historical calendar year results. So that is a check in the box from PlanPilot's analyst team that this fund has delivered on that value proposition that it's promoting. So with that in mind, jumping to the next slide, a very familiar looking chart, and it's the same chart that we were looking at just a few slides earlier, but it's been slightly modified based on that marrying of qualitative and quantitative attributes of this fund that we acknowledged. This was a proactive step by PlanPilot's team to ensure that we were correctly aligning our investment analysis with the true objective and the true gauge of what would be a success or failure for this fund when analyzing historical performance. So the key difference on this chart is the fact that we are now looking at rolling 10-year excess returns rather than rolling 5-year excess returns. And why does that matter other than simply taking a longer historical period and analyzing it? We acknowledge and understand how the markets work. A full market cycle is going to, the most recent bull market is a perfect example. 5 years is not enough to capture a full market cycle of performance. And we're analyzing a fund that is prided on its downside protection, and where that has historically generated success is over the course of a full market cycle. So if we're not analyzing the investment under that same lens, we're predisposed to make poor decisions related to whether or not that fund is delivering. So on a rolling 10-year basis, the relative performance of this fund looks a little bit different for the better when you compare it to its peer group and benchmark. You can see that since the fund's inception, which was all the way back in 1992, the fund consistently outperformed its benchmark on a rolling 10-year basis in a vast majority of rolling periods up until the most recent rolling 10-year periods. And why we're comfortable with that is because we acknowledge that we are just now emerging from the longest bull market in the market's history. This has basically been an extended market that contrasts where the fund should be performing well and adding value. If you focus on the right side of this chart, you can still see that while the fund has trailed its benchmark in the most recent rolling periods, it's always performed in or very close to the top quartile of its large cap benchmark. And the last points that we've highlighted on this slide here and on the chart specifically are the periods where we've acknowledged that the fund has been in its best, where you see the fund's rolling long-term performance peak, not by coincidence, perfectly aligns with all of the major market downturns that we've endured over the last 20 plus years. Using that first one as an example, because there's a little bit of a delayed effect here. When we're looking at that dot-com bubble highlighted on the chart that's falling right around the 2008-2009 timeframe, keep in mind this is looking at the 10 years of performance leading up to that point. So what that relative performance is telling us is that the fund did exceptionally well as markets were challenged during that dot-com bubble burst, and that translated to very, very successful long-term rolling excess performance of the benchmark. If you move to the right on the chart, you see the same delayed effect with the great financial crisis, and while not nearly as pronounced, you see the same thing experienced as a byproduct of the sell-off we had at the end of 2018, and most recently the COVID sell-off at the beginning of the year. So all of that in mind, and the slide is appropriately titled Looking Forward. But before doing that, I wanted to summarize and look backward. At this point, and at the point that we decided to add this investment to our clients' investment lineups, we felt we had certification that the fund has consistently achieved its objective for almost 30 years since its inception. And this slide by itself could largely point to that point. And equally importantly, because now we've got a good grasp of the historical results, we've added the context of the fund's objective and given ourselves some assurance that it was not just luck that helped achieve this historic success, but these sub-bullet points add to the forward-looking acknowledgement that the fund can continue to deliver the way that it has in the past. So not only had the fund demonstrated its value for the last 30 years, we acknowledge that it did that with a very cohesive, firm structure and low turnover of its leadership. The same people that have contributed to the fund's success historically have been around for all of that success. They continue to be in place. And the investment strategy itself has been very disciplined, and there haven't been any changes to it in its 30-year history. So when you look at any points on this rolling orange line, on the previous slide, we know that we are looking at the same strategy bundled up into the products that we are analyzing today. It's a testament to not only the product itself, but the endurance of the long-term strategy. So summarizing this, we felt comfortable that the fund had demonstrated its in-house expertise had added value long-term in all things considered, because ERISA dictates you are responsible for making prudent decisions based on all factors that are available at the point of investment. That's why you see those disclosures on any investment website that tell you future results are not indicated by what's happened historically. So at the point of investment, we felt that we had reasonable assurance based on all information available to us at the time that the fund would continue to generate value for its investors. And the last point that I'll make before I turn it over to Bill again to close out, and while I make that point, I'm going to jump back a few slides to again highlight where we invested in the fund and what immediately followed. So having that good fundamental understanding of the fund before we made the decision to invest has also given us the discipline to properly oversee it on a go-forward basis. Without that depth of knowledge, you could very easily make the argument that obviously if the right half of this chart were missing, say for example, we invested in 2013, you can see that the fund was challenged heading into 2014. If we were not as comfortable with the strategy itself, how it should perform in the market environment that we had endured at that time, we may have made the decision to improperly remove the fund from clients' menus at what truly would have been the most inopportune time. So jumping back to this last slide I was covering, those last few bullet points summarize just that. This deep fundamental understanding of the products and its historical results gives us some predictability regarding what the fund's investment strategy is going to do on a go-forward basis. It's when the fund is performing out of line with those expectations that there may be more cause for concern. So with that, Bill, I'll turn it back over to you.
Sorry. Thank you, Tom. Helps if I take myself off of mute. We didn't see any questions come in during the webinar, but certainly with that said, if you do have questions, please send those to us. We'd be happy to address them. I think Tom did an excellent job today of showing how we can remain convicted in a fund when the numbers don't necessarily look so good based on our qualitative analysis. Looking ahead, there's a mention here of red flags. We'll flip the script and look at cases where qualitative factors changing can help us prepare for potentially not so good numbers ahead. And so it's important to look at this in reverse as well and recognize we do need to continue to monitor those qualitative factors. Is there a change in the management team and so forth, and look for things that could give us hints of potential problems ahead. So hope we thank you first of all for joining us today. We hope that you will join us for future webinars. And again, if you have any questions related to this webinar, please do not hesitate to send those either to Tom or to me, and we'll be happy to address those. Hope you all enjoy a great rest of your day, and we look forward to connecting with you again soon.